5 years of cash. Not 4, not 6, 5. That's the exact buffer that makes a market crash not matter to your retirement. 14% of new retirees actually have it. The rest ride the market on week 1 of retirement. And sequence of returns risk is the biggest killer of a retirement plan. Strike out the 4% rule alone. Bill Bengen's framework assumed you'd sell stocks in a crash. That's what destroys portfolios. The 5-year bucket solves exactly that problem. The S&P 500 recovers from a 30% plus drawdown in 26 months on average, plus 24 months of safety margin. That's your 5-year window. With 5 years of cash, sequence of returns risk effectively dies. You never sell equity in a downturn. You draw from cash, you wait. Today, the exact construction. How to build it, how to refill it, how it saves your retirement when the market falls 40% the day after you retire. Wade Pfau's 2024 stress test. The safe withdrawal rate jumps from 4 to 4.9% with a properly constructed bucket. On a $1 million portfolio, $9,000 a year more you can spend. Picture your portfolio as a house on a plane. Every decade or two, a tornado rolls through. The house shakes, windows crack, the sky gets green. You don't sell the house during the tornado. You go to the storm cellar and you wait. When the storm passes, you come up. The house is still there, 2007 to 2013. The gray line sold equity in 2009, never recovered. The red line used the cash bucket, waited, now worth $1.3 million. Cash is the storm cellar. 5 years of expenses. In a money market. Earning modest interest. Insurance against panic. The worst post-war drawdown, 56% in the Great Recession. Peak to trough took 17 months. Full recovery 4.5 years. A 5-year bucket covers it. 5 years covers every bear market in modern history. 1973. 2001, 2008, 2020. All done inside 5 years. The cushion isn't free, but it isn't expensive either. Money market funds yield 4 to 5% in 2026. That covers most of inflation. You're paying maybe 1% of real return for peace of mind. 1% per year. That's the price of a storm cellar. Pfau's stress test shows you're likely to come out ahead anyway, because you don't panic sell. Sequence of returns risk is just selling low. Formalized, named, scary. The bucket removes the compulsion to sell. Next, the exact build. How many years? What instruments? How to refill? Before the 3 rules, quick note. We built a free bucket sizer calculator, link in the description. No email, no pitch. Paste in your annual spend. Returns your exact bucket size, refill schedule, and recommended money market fund. 30 seconds. Now, 3 rules to build the bucket correctly. First rule. Size the bucket to 5 years of gross annual expenses. Gross, meaning before Social Security, before pension, before anything else that shows up automatically. $72,000. The median retired couple's annual spend. Bureau of Labor Statistics, 2025. 5 years of that is $360,000 of cash bucket. $360,000 in cash. Not liquid investments, not bond index. Cash. Money market fund. Earning 4 to 5% today. 2 years is the default advice. Not enough. Bear markets in 2001 and 2008 had 18-plus month drawdowns with slow recoveries. 2 years runs out. 11% failure rate with a 2-year bucket. With a 5-year bucket, failure drops to about 3%. 3%. That's how much the bucket matters. You're trading 1% of real return for an 8 percentage point reduction in failure risk. That is the single best risk trade in retirement planning. Where to hold it? Vanguard via MFXX yields 5.05%. Fidelity SPAXX 495. Schwab SWVXX Go 490. All institutional grade Treasury money markets. FDIC. Backed equivalents for peace of mind. Linda and Doug, both retired, 66 and 68. 1.8 million portfolio. 360,000 in the bucket. 1.4 million in a 70-30 index split. Three layers: money market for expenses, bonds for medium term, equity for growth. The bucket never touches the equity sleeve directly. The gross trick: don't subtract Social Security from your expenses before sizing. Sizing gross gives you a margin. If Social Security has a bad year, your bucket still covers you. Size gross, not net. The extra cushion is cheap insurance on a 30-year plan. Second rule: refill only in good years. You refill the bucket from your equity sleeve, but only when equity has had a positive year. The protocol: equity up more than 20%. Refill the bucket fully. Up 5 to 20, refill just 1 year. Equity down, don't refill. The bucket shrinks in bad years. That's the point. When you refill after a good year, you are mechanically selling high. The opposite of panic selling. This is the discipline the bucket buys you. Calendar: January. Look at the prior calendar year's equity return. February: execute the refill trade if up. Rest of the year, do nothing. The mechanical simplicity is why it works. 72,000 drawn from the bucket each year. After year 1, bucket has 4 years left. After a good market year, refill back to 5. Through the Great Recession, the bucket went 3 years without refill. From 5 down to 2. Then 2010 happened. The S&P returned 15%. Refilled all 3 years in one trade. 19% of retirees actually refilled on schedule during the 2020 recovery. 81% looked at the S&P at a record high and said, "I'll wait." They're the ones exposed to the next drawdown. Don't wait for more. You'll never see a clear top. Mechanical rebalancing, January review, February execute, close the laptop, mechanical, not emotional. The day your bucket decisions become emotional, you are back at sequence risk exposure. 3 mistakes. 1. Refilling in down years. Sells low. 2. Never refilling. Bucket shrinks to nothing. 3. Partial refills. No discipline. Pick the rule. Execute the rule. Don't negotiate. Set a calendar alert. Every January 1st. Review bucket. Refill if up. One decision once a year. That's the whole protocol. Third rule: during a drawdown, draw from cash first. This is the rule everybody gets wrong, even your advisor. During a bear market, year 1, only from cash. Year 2, if it's still bad, cash plus bonds. Year 3 plus, equity is usually recovering. You never sell equity at the bottom. Standard advice says draw proportionally. Wrong. Proportional withdrawal in a bear sells equity at the bottom. Exactly what sequence risk is. $1 million portfolio, 2008 to 2013. Proportional withdrawal ended at $640,000. Cash first ended at $1.28 million. Same market, different rule. $640,000 across 7 years. From one procedural difference. The rule is worth more than most portfolios. William, 69. Retired 3 years ago, 1.2 million portfolio with a properly sized bucket. A crash hits. S&P drops 32%. Panic says sell equity. The plan says draw cash. William draws cash. 3 years later, the market recovers 38%. William's equity sleeve is intact. Because William didn't sell equity, he recovers $380,000 of market gain. Not 200. The difference is the bucket. The bucket gives you procedural edge, not predictive edge. You don't need to know what the market will do. You just need the rule for when it happens. During a bear, check your bucket balance once per quarter. Don't check your full portfolio. Cancel anxiety subscriptions. Nothing you can do about the market. Plenty you can do about your stress. Psychology matters. The bucket makes a crash a 5-year problem, not a retirement problem. Retirement lasts 30 years. A bear lasts 2. Don't confuse the frames. You have time. Always. The bucket is the proof. One more thing. Let me prove the rule across 40 years. Because rules that sound good often fail in backtests. 97% success across every 30-year window since 1985. Median ending balance, 2.4 million. Worst case, 420,000. Even the worst case didn't run out. Nobody ran out. 0 failures. That includes starting retirement at the peak of 2000, 2007, or 2020. Proportional withdrawal, 76%. 24% failed in some version of the backtest. The bucket is not a small improvement. It's a structural one. Two simple factors explain it. You never sell low. You always have a margin. Combine the two and the math moves decisively in your favor. This isn't timing, it's structuring. Different game, more winnable. The bucket changes which game you're playing, from guessing to executing. That's the whole edge of the 5-year bucket. Now, the takeaways. This is a repeatable system, year after year, crash after crash. It doesn't depend on you being smart, just disciplined. 3 moves. Tonight. Before the next bear market. 1. Multiply your annual expenses by 5. That's the size. 2. Open a money market account at Vanguard, Fidelity, or Schwab. 3. Set a January 1st calendar alert for the annual refill review, 1% per year. The cost. Peace of mind delivered. Sequence risk killed. The bucket works while you sleep. Exactly what retirement money should do. Subscribe. Next week, we map the tax torpedo, the thing that turns a great withdrawal plan into a mediocre one. Secure your license to chill. Fix the wealth drain today.